Good afternoon, everybody. We decided to conduct, for the last couple weeks, we've been talking about bond alternatives, but I started to get some feedback that, people weren't understanding, maybe the structured note and where that might be a fit, or we're going to talk about something, tornado warning. So I said, let's go back to scratch. And last week we talked about stocks and bonds, and I don't like to take anything for granted. So if you'd like to revisit that topic, feel free to let us know and we'll get you that recording. But today's topic is going to be on unsystematic and systematic risk. It's important that you understand this concept. In the next upcoming weeks, we're going to talk about the milk cow and the hunt for yield and what kind of cows should you have. And then we'll follow up with, if we don't do our monthly market update 2 weeks from now, it'll be tornado warnings versus tornado watch. But I think I might throw in a recap of March in between there. So that might be, 3 weeks out. So we're going to start off with, what is equity? Equity equals ownership. And it's typically referred to as a shareholder's equity, or owner's equity for privately held companies. Represents the amount of money that you would be returned to a company's shareholders if all the assets were liquidated and all the company's debt was paid off in case of liquidation. In the case of acquisition, it is the value of a company's sale minus any liabilities owed by the company not transferred with the sale. In addition, shareholder equity can represent the book value of a company. Equity can sometimes be offered as payment in kind. It also represents the pro rata ownership of company shares. So again, I don't take anything for granted. I think we all, especially after last week, understand what stocks are. And stock is another way of saying you were an owner of a company. And if I were to turn around and say, hey, we opened up a lemonade stand on the corner and we incorporated and we issued one share and you put $10 in capital to open that company, how much could you lose? And the answer is that lemonade stand on the corner could lose everything, could lose all $10. That's the risk of ownership, right? But the upside is unlimited, the sky's the limit, right? If we have the best lemonade in the area, everybody far and wide is going to come to buy our product and we get all the profits from that. So that's a very watered down explanation of what equity is and what stock ownership is. But why it's so important is because, many investors were invested in the marketplace and they lost in 2008 between 30 and 50% of their portfolios. Very painful time. This might be better known as the housing bubble burst. But how did that happen when most of these investors had diversified portfolios? True diversification only takes place when investors take steps to better protect themselves against all types of investment risks that lead to market loss. So really, to simplify, there are really two types of investment risk. There's unsystematic and systematic. And so these words, I think, are worthy of a deeper understanding. So why invest in stocks and bonds in the first place? And the reason is for, just as I explained in my lemonade stand example, the potential for total return. Total return equals all the gains or losses plus or minus any yield. And we're going to talk about in depth what yield is with the milk cow, but that's, any dividends or any profits that come along as a result of the ownership of the corporation. Now, we can have growth type stocks, we can have value type stocks, and then we can have income portfolios, right? So this is typically language that is used in the investment arena, and we will continue to sort of better understand what's going on in the marketplace on a go-forward basis. But here's the old adage, right? And intuitively, we know this, right? We don't want to put all of our eggs in one basket. Because if we were raising chickens and collecting eggs out in the hen house and we put all the eggs in the basket and we trip and fell on the way back to the house, we, in essence, have lost everything. The example, when I'm doing classes last year over at Rutgers Business School, I always used to use this analogy. If I took an egg, and let's say there were 30 desks in the room, and I put that egg on one desk. Now, that represents owning one company. If I come up and I bump that desk, would you agree that that egg could roll off, fall to the ground, and break, and we've lost the egg? That's akin to having all your eggs in one basket, right? So just having one, all of our are heavily weighted into one stock. So that's called unsystematic risk. And the risk that is typically associated with having all your assets or eggs in one basket, think Enron, right? And this is why ERISA rules were created. Enron had poor management, scandals. There was pilfering, and then you had one of the nation's leading accounting firms, Arthur Andersen, going in that was in on the corruption. You could also have employees go on strike, right? The CEO dies, the product didn't perform as well, right? Poor management, malinvestment. Any of these things can lead to or equate to bumping the desk and the egg falling off. And that's why if a company is offering as part of your compensation package, stock ownership in the company, I agree that we want to own stock in the company we work for to a degree. But every once in a while, probably is prudent to reevaluate the weightedness of stock ownership in the company that you work for. So, we'll talk more about that. But recently I had a client that lost his job and has a lot of stock, vested stock in the company. And now we're systematically strategizing to liquidate that and start to diversify to reduce the risk. But here's an example that typically I've shown in the past, and I think it really just is telltale, and that is a Citigroup, right? So this stock back in the early 2000s, was a financial powerhouse, right? Citigroup. I mean, yeah, you work there, or if you own stock there, like, what could go wrong? And then in the span of 1 year, Citigroup became nearly worthless due to the malinvestments and the toxic derivatives or credit default swaps that they were in. So this is the risk, and this is where the picture tells a thousand words of an egg falling off the cliff or off the desk. So what's the solution to unsystematic risk? And intuitively, or we probably instinctually, or at least educationally, have been taught that now asset allocation. Investing in a broad range of companies and sectors in an effort to decrease the risk and increase return while accounting for individual investor risk tolerance and investment objectives. That's what has been created and been proven to reduce unsystematic risk. So you probably are familiar with pie charts that look like this. And this is just an example of allocations that people typically will start to do. And when you take those risk questionnaires, when you're looking to open an account, whether it be your 401k or your custodian or some type of investment portfolio that you're putting together, we know that, okay, I'll have some in cash and some in stocks and maybe some non-US stocks and bonds and others, right? So, this we're familiar with. And then, they've checked the boxes, the custodian, that they have taken a pulse check of your risk tolerance. So basically that's a CYA that most investment firms are putting out there to make sure that clients don't come back and sue them. But I was just on the phone with a client today, and they said something that they were talking to management at JP Morgan. And, one of the managers there said, yeah, he acquired all his wealth through, investing in different asset classes similar to this. And I caution against getting what I call water cooler advice. You cannot take what one person is doing and then rubber stamp that and use a size 9 fits all approach to an investment strategy. And this is why I'm always cautious about, where are we getting the advice from? And is it really specific to your circumstances? And everybody's unique. So here's a further example of asset allocation, and it does in fact work, right? So if now if we're going to diversify amongst all these different sectors, different percentages, Citigroup was actually held now within the financial services. So if it fell off a cliff, the entire portfolio didn't go down. So in theory, in actual practical application, diversification is an effective strategy, and utilizing asset allocation to match your risk tolerance makes sense. But is asset allocation really enough? Now, this is a picture of a classroom. So, again, when I'm doing classes over at Rutgers, And I will then ask, if I took the egg analogy that I gave earlier, and now let's say that I put an egg on each and every one of these desks, would you agree now that we are in essence diversified? That if I go up and bump one desk, let's say in the upper front left-hand corner, it won't necessarily affect the egg on another desk. And logic would dictate that is an accurate statement, Chris. Well, is asset allocation really enough? The answer to that, not if we want to protect against investment risk number two. That is systematic risk. And systematic risk cannot be diversified away. It's risk inherent to the entire market or the entire economic system. So the analogy I would give here is, would you agree that if an earthquake were to hit New Jersey, that all the eggs would fall? And that's the point that you have to understand, is that as well diversified as you may be, you may not be able to diversify away from that type of risk. And that's called systematic risk. And we have to plan for it and at least acknowledge that it exists. Here are examples. We know war is never desired, but it can absolutely affect the markets. 9/11 absolutely is a perfect example of that, right? COVID-19 just happened last year. So most portfolios that I saw were down, somewhere in the neighborhood of 30% or plus. Inflation can start to affect that. Higher taxes, recessions, depressions, credit crises, and like I just said, a natural disaster, whether it be a flood or a hurricane or a tornado or an earthquake, could affect how your portfolio performs. And again, it can't be diversified away. So this picture here, there's a lot going on here. I'm going to move my arrow over here. I put this up here. So think of this: the unsystematic risk can be diversified away, but this portion down here cannot. That's the systematic risk, and it cannot be diversified away. The risk is inherent to the entire market or the entire economic system. But we can reduce risk by, here's one egg in one basket, so we have all the risk, but very limited. But if we increase it to more eggs, then we smooth that curve. But if that systemic risk starts to happen, then could actually, our whole portfolios could lose. So that's why dealing with somebody that's well-versed in helping you to design a portfolio that can smooth the volatility that seems to be ever present now in the marketplace is absolutely critically important. So I'm just going to leave us with this. I think a good starting point is understanding your risk level. And I was talking to a client yesterday, and their risk level 10 years ago, they were like, yeah, I put my money in there, it's made a lot of money, but now they're looking to retire in 2 years. We have to start to dial back the amount of risk that we're doing. Everybody wants to make money. We all want to make money. I want you to make money. But remember, last year this time, Warren Buffett, and he's arguably one of the richest men in the world and one of the greatest investors to ever live, has taken the statement of rule number one, don't lose money. So part of our portfolio is understanding the risks that we have in our overall portfolios. And then what can we do to add into to reduce some of that what I call drawdown or that volatility that we've seen of late. So that's why if you join me in the next couple of weeks and we start to talk about, the hunt for yield, and we start to talk about, alternatives, right, to bonds and some of the risks, I am less concerned about equities on a go-forward basis than I am about bonds on a go-forward basis. And that's why I've been harping on it for years now, because we're at the end of what we call a secular bull bond market. And what that basically means is that, interest rates are at all-time lows. They're starting to creep up. Yield is starting to go up. And we're going to talk about this next week on our understanding our yield portfolios, that as yield starts to climb, right, as interest rates start to climb, values of those bonds start to decrease, and we can actually lose money in our supposedly safe asset allocation design as we approach retirement. Think about it. And this is why I've been such a naysayer of target date funds, right? Because they're on autopilot. In theory, you turn around and say, oh, well, I'm getting closer to retirement. I want less equities and more bonds. And right now, all the bellwethers and signals start to indicate that that is probably not a smart strategy heading into retirement. So, again, I just wanted to you just reinforce some of our belief systems and philosophies on a go forward. This is our weekly call. These are our disclosures. Quite often, what I suggest here is based on my experience and professional opinion. And then ultimately, though, if you have questions, or if you like an evaluation, if you want a second opinion, that's quite often, people, I'm starting to talk to a lot of folks on LinkedIn, right, because of COVID, right? And I just say, look, and they're, I got a guy. All right, great. You would suspect that you do. Does it hurt to get a second opinion on what you're currently doing? And if there's no cost or no downside, at least you understand what you have. So if this is something that is appealing to you, I'm gonna suggest that you reach out. If not, I wish you all well. Spring is, and I want to continue to be a resource for you each and every week. If you have questions, please reach out. Give us a call. 732-302-1810. Have a great day. Bye-bye.